As those tensions escalate between the US, Iran and Israel, global markets are once again on edge. Oil prices are rising. Investors are moving toward safe haven assets, and emerging market currencies, including the South African rand, are under pressure. To expand the conversation, we're joined now by Gary Booysen, who's Director and Portfolio Manager at Rand Swiss. Gary, a very good afternoon to you. Thank you so much for joining us. I mean, given the reports that the ripple effect is that the rand has weakened, oil prices are rising, and emerging market currencies are under pressure as traders seek this safe haven like the US dollar and gold. How has the escalation of the conflict affected emerging markets overall, especially here at home?
I think the markets took the initial strikes over the weekend in their stride, and really we're seeing the fallout certainly on the local exchange today. Most of yesterday we were positive and finished the day negative, but managed to hold up well in early hours. Today is a very, very different story as we see the conflict widening across the region. So we have the likes of the oil share index down around 4% at this stage, led lower by the resource counters. So the resource index down over 6%. A lot of that, the gold miners also falling. So while gold is traditionally a safe haven, we do have the gold price off almost 3% at this stage, and that's putting a lot of pressure on the likes of Anglo Gold, Harmony, Goldfields. The only real, I suppose if you want to call it a resource stock, more an energy stock, is Sasol, which is up significantly on the back of the higher oil price. Brent crude oil actually touching $85 a barrel earlier. And I think this really on fears that there is the potential for a severe supply disruption if the Straits of Hormuz were to close. If you don't know, this accounts for around 20% of global oil trade. And, obviously it's a significantly important choke point for the likes of China and India as well. So, we haven't had the straits closed, via, either attacks from diesel submarines or mining of the strait, but it is effectively closed because of the cost of insurance of moving oil through that choke point having skyrocketed. It is effectively closed. And I think traders looking at the scale of the conflict and starting to say it's more and more likely that something is going to happen. And if that's the case, you could very easily see Brent crude oil above $100 a barrel.
I suppose then, with all these moving parts, the big question is how will the higher transport costs from elevated fuel prices feed through into food inflation and the overall cost of living?
Oh, well, in a very bad way. Yeah. So obviously, if we look in the South African context, South Africa is a net oil importer. So we are reliant on the commoditized price of oil. We would expect fuel cost spikes. If we look at if you look at the current data, the March petrol price increases, for example, are probably already in. We're looking at 20 to 30 cent increases. But depending on where the Brent crude oil price settles, this could be significantly higher. So if you look at CF data, you're talking about probably a R1.30 increase at this stage. Now, of course, fuel is used in the transportation of everything, so it moves into our food prices as well, and inflation becomes a real concern. And there is a precedent for how this played out in the past, and it was the Russia-Ukraine conflict. That was another large-scale supply shock to oil markets. And what we had, if we look at an equity market perspective, we had global markets down around 20% over 2022. So this is very serious. It's going to affect equity pricing. It will affect inflation expectations. The idea that central banks have a lot of room to cut interest rates and supply cheaper cheaper money into the market and through looser monetary policy, it has to be reconsidered now. So it's going to be very inflationary. It'll affect food prices. It'll affect the price of everything, and that will be a real concern.
Beyond the impact on oil prices and fuel hike effects, to what extent is, or would you say, global geopolitical uncertainty is driving the volatility in the South African financial market? For one, have foreign portfolio flows out of South African equities and bonds increased as markets price in the geopolitical risk?
Yeah, we don't have that data, to hand. That's not a data that gets published on a daily basis. But I would say almost certainly we're seeing portfolio flows put pressure on local markets. Typically the big passive flows, large fund managers that have mandates to, invest either in emerging markets or developed markets, typically do move our local exchange. And just with how broad based the selling is currently, this is large. Kind of institutional flows, if you want to put it that way. It's not in any one specific stock. This is a move from kind of what was slight risk off trade to severe risk off trade, and emerging markets tend to get hit on the back of that. And that's exactly as you say. It's foreign investment managers pulling money out of our country. That's obviously putting pressure on the local currency. So we have rand dollar exchange rate touching 16.40 at this stage. We were below 16 a couple of days ago. So that's affecting the local currency, and obviously, putting severe pressure on our local equity markets and bond markets as well.
Very well. Thank you so much for that breakdown. Of course, giving us the impact of a big and developing story insofar as Iran, the US and Israel are concerned. The escalating conflict, which we continue to monitor. That was Gary Booysen, Director and Portfolio Manager at Rand Swiss.